Welcome to the Explainer. Today, we're going to talk about a really powerful tool for your trading analysis toolbox, moving average envelopes. We'll break down exactly what they are and, more importantly, how you can use them to get a much clearer read on the market. So let's start with a problem I know we've all faced. You see a buy or sell signal from a moving average, you get all excited and jump into a trade, and then it just fizzles out. It was a fake out. It's so frustrating, right? And it can definitely be costly. See, with a normal moving average, the signal is pretty simple. Prices close above or below the line. But look at how often the price just kind of dances around that line. It creates so much uncertainty and, it can easily fool you into making a bad trade. So here's the million-dollar question. How do you get that extra bit of confirmation? How can you be more confident that a trend is actually the real deal and it's got the juice to keep going? Well, this is where moving average envelopes, or MAE, can be an absolute game changer. And don't worry, despite the name, I promise it's a lot more exciting than mailing a letter. So let's properly introduce this thing. I want you to think of it like adding a set of guardrails to your regular moving average. It gives you a much clearer picture of what the price is really up to. Okay, so what is it? It's actually pretty simple. It's made of 3 lines. You've got your normal moving average smack in the middle. And then you have 2 extra lines, one above and one below, that create a channel. This channel is what helps you figure out a trend's strength and spot potential reversals. So the whole system breaks down into 3 key parts. You have the upper envelope, which kind of acts like a ceiling. You have the lower envelope, which acts like a floor. And right in between, you have the moving average as your center line. All 3 work together to frame the price action. And the magic here is in the math, which is actually really simple. These outer lines are just a set percentage, like, say, 1 or 2% away from that central moving average. This means they move in perfect sync with it, creating this consistent band that prices often respect. All right, let's get to the fun part and talk about its first big use case, building our confidence when we're in a trending market. This is all about getting confirmation. The rule here is simple, but it's incredibly powerful. See, it's not enough for the price to just close above the moving average anymore. For a strong, confirmed buy signal, you want to see the price close decisively above that top envelope line. That's a real sign of serious bullish strength. And check this out in action. On this GBP/USD chart, you can see the price first pokes above the moving average. That's a potential signal, but the real confirmation, the okay, this is happening moment, is when it breaks and closes above that upper envelope. That gives you a much stronger reason to go long. And you guessed it, the same exact logic works on the downside. A price that closes below that bottom line isn't just a small dip, it's a powerful signal that the bears are in control and a real downtrend could be getting started. Okay, that's great for when the market is trending hard. But what about when it's not rocketing up or falling off a cliff? When it's just kind of drifting sideways? Well, moving average envelopes have a second, totally different use for that. Now listen up, because this part is absolutely critical. Using envelopes to spot overbought and oversold conditions works best, by far, when the market is moving sideways and that moving average is pretty flat. If it's steeply angled up or down, this technique just won't be as reliable. So in these flat markets, the envelopes basically become boundaries. When the price pushes up and hits that upper envelope, you can start thinking it's potentially overbought and might be due to reverse. And when it drops down to the lower envelope, it could be oversold and ready to bounce. This chart is a perfect example. The market is pretty much directionless, right? And the price is bouncing between the upper and lower envelopes like a pinball. The envelopes are clearly defining that trading range for you. So the strategy in a sideways market becomes pretty straightforward. You're looking for a sell signal when the price hits that ceiling, the upper envelope, and starts to fall back inside. And you're looking for a buy signal when it hits the floor, the lower envelope, and starts to bounce back up. Okay, let's wrap this all up. We've seen how versatile this indicator is. It can serve 2 very different but very important functions, depending on what the market is doing. So the big takeaway here is that moving average envelopes kind of have a dual personality. In a strong trend, use them for confirmation. In a flat, sideways market, use them to spot potential turning points at the edges. So there you have it. You now have a tool that can help you filter out a ton of noise, avoid those super frustrating false signals, and see the market's boundaries with way more clarity. That's a massive advantage. The only question left is, how are you going to put it to work?